So Nate, pleasure to have you on the show again.
Yeah, thank you.
And excited this week to talk about a lot of stuff that's going on in the mortgage industry that's changing. It's sometimes, misconceptions people have. But, one of the topics you and I had talked about bringing into the show was, a lot of people have a misconception about how interest rates are calculated.
Yeah, there's a big misconception out there with those. Basically, whenever people are looking at rates, a lot of times people think, well, the government sets the rates. Well, the government does not set nor control interest rates out there. You have to look at a number of different factors whenever you're trying to back into what the rates are. And while there are certain parameters that are set and consistent amongst lenders, there's a lot of variables that are not consistent, and that's why you see fluctuations in rate. You can call 2 or 3 places and you can get 2 or 3 rates for the same exact product, the same exact scenario. So basically what you have is you have to look at first where you're getting the money from. For example, if you're getting it from a local community bank who loans their own funds and collects the payments on that money, they will offer a certain set of rates because those are not Fannie Mae, Freddie Mac backed loans.
Generally called a portfolio loan.
Portfolio loan, correct. And they don't have the same liquidity that a Fannie Mae or Freddie Mac loan has, so therefore, on average, you're going to find that those rates are a lot higher. Now, the convenience of that is sometimes they're willing to do things other places aren't, so that does make it nice and definitely a needed product. But as far as rates go, they're not going to typically be the most competitive in that nature. So you have that option. Then you have all your Fannie and Freddie lenders. That is independent mortgage companies, Plant City Mortgage, for example. All your major lenders, all your big name companies that you think of. If you can think of the last 5 lender commercials you've seen on TV or the radio, I can assure you those are all Fannie Mae, Freddie Mac backed,
right.
Correct. And I don't want to mention their names, but
right, I understand. Yeah.
So you got those companies as well. So what happens is whenever lenders loan through Fannie Mae or Freddie Mac, the base cost of those mortgages is determined by mortgage-backed securities trading. And what that is, for example, a mortgage-backed security is a very low-yielding investment, kind of like a treasury, but it gives just a little bit more than a treasury would for a big entity. So just like me or you, in an uncertain economic time, we would go and put our money in CDs. You're not going to make a lot of money, but it's safe money. You're not going to lose it for the most part. Well, that's what a mortgage-backed security is to a huge financial firm. It's like it's a CD for the big companies, basically. So when economic times are turbulent and they're uncertain of what the markets are going to do, they typically rush to these mortgage-backed securities and invest their money there because it's safe money. They're not going to lose it, they're not going to make a lot, but it's safe money. So you have the mortgage-backed security market, and typically, and this isn't a rule, this isn't a guaranteed rule, but in general, when the economy is recovering and gaining steam, mortgage-backed securities don't do as well, and therefore their cost rises, which pushes up interest rates. During uncertain times, it's whenever they will typically decline because everyone rushes to the safety of these things. So the mortgage-backed security market is a consistent market. So what you have to do is you take that first block of costs built into your rate as mortgage-backed securities. The second layer is where you get a lot of variables. The second layer is the cost to distribute that money to the public. And that's where banks, credit unions, lenders, and mortgage companies all have different overhead. You have very different overhead depending on the company, and also built in there, of course, is their profit margin. So you might have some companies that have low overhead, but they have very high profit margins, and that's going to be reflective in your rate. Companies like ours exist for that reason. We have, like for example, wholesale lenders that actually bypass. They don't have buildings across the nation. They have basically a few centers throughout each state that they run everything from, so they don't have the cost of retail outfits, massive advertising budgets, etc. And they loan money through companies like ours. It's an equivalent model of if you can think of an independent auto insurance agent, for example. He represents a multitude of national companies, and those companies basically pay him a fee when he issues a loan, so the client doesn't have to pay the auto insurance a fee. And that's another cheaper way to get it to the public. So you basically have those things involved. And so once you get to all that, then it comes down to just your program guidelines. Whether you're getting a loan for FHA, VA, USDA, or conventional, all those programs have their own set of base rates. And then on top of those base rates, depending on which program, you have some adjustments. I'm just going to go through a real quick bullet list here to share with you some of the adjustments that really come out in your rate. Property type. If you're buying a single-family home or a townhome, that's your best rating factor. Then you have, down from that, condos, and then down from that, mobile homes. Those have higher increases to your rate depending on the property type, best one being single-family home. And by the way, a townhome is the same as a single-family home in this regard.
Because it's got a legal description,
it's got land
attached to it.
And a lot of people look at that and they say, oh, it's a townhome, it's a condo, because it looks and feels the same, but there's a very big difference.
It's the legal description.
You got it. You got it. You own the dirt underneath the townhome.
And someone that kind of the layperson that doesn't know how to determine the difference, if you're looking at online at a property, you can usually tell the legal description by if it's condo, it usually says something along the lines of an undivided common interest, an undivided interest in the elements. If it's a townhome, it'll have lot or block, generally in the description, and sometimes unit number with a legal description, but no undivided interest or unit number, with undivided common interest. So usually that's the determining factor between condo and townhome.
And the next biggest factor is, or is about the same biggest factor is occupancy. If you're buying or refinancing a home and it's your owner-occupied property, that gets the best rating factor comparative to an investment home. Obviously, if you're not going to be able to make your payments, you're not going to make your payments first on the investment home before you lose your primary home. So you get a better rating factor for that. What a lot of people don't know, though, is second homes, vacation homes, those actually get the same rating factor as an owner-occupied home. Now, some community, like again, if someone says, well, that's not what I was told. If you went to a small community bank, they do charge different rates for those. But as far as on our books, they're all the same.
As far as a Fannie, Freddie.
Yeah, there's no hits for that. So you can buy it. So when you see these rates out there and you think, I don't know if I can afford a vacation home because maybe the cost of the rates are going to be just as competitive. I mean, it's an amazing time to get a vacation home. So you have that. The next factor, loan to value. This is basically when you're buying a home, how much money you're putting down. Whether you're putting down 5%, 20%, 25%, so forth and so on. On average, the lower your loan to value, of course, the less hits there are to your rate. If you're doing a refinance, it's based on the appraised value. How much is your loan amount comparative to your appraised value? Let's see, a couple other ones here. Basically, the type of loan, whether you're purchasing a home or refinancing a home and simply paying off the existing mortgage, that's the best factor. The worst factor in this scenario is a cash out, meaning you're withdrawing money, you're pulling out money in addition to your loans.
A little more risky.
Correct. And even if you're combining a first and a second mortgage, if that second mortgage was not used to purchase the home, that means at some point you did pull cash out,
right,
and they classify that as a cash out, even though you're really not getting cash out in your mind.
Yep.
So you have that. Escrows, if your loan to value is over a certain threshold, whether or not you include tax and insurance in your payment, that can be a factor as well. If you don't, sometimes there's a hit to that. It might not be a hit to your rate, but it is a hit to the cost. Whether it's going to be reflected in your rate or cost, it's going to be somewhere. Obviously, credit scores is always a factor. Credit scores are a much larger factor when it comes to conventional loans. FHA and VA loans, they look at credit score, but it's nowhere near the significance that it is on a conventional loan. And last but not least would also be the length of your lock. People say, oh, can't you lock loans for 90 days, 120 days? You can, but I wouldn't. I mean, it's going to be very costly. It's not a good idea. A lot of times the benefit is offset by the cost.
So it's great analysis there on how interest rates are calculated.